Hi, my name is Munaf. I'm a financial planner with GMI. I've been practicing as a financial planner for a little over 10 years now, and I focus on investment and retirement planning. Today, I want to talk about Shariah-compliant funds, share a little bit about how they work, what the key principles are, and then as a Shariah-compliant investor, what should you consider in order to ensure that your investment portfolio has been optimized and appropriately diversified for you to be generating positive inflation beating returns. What are the key principles of Shariah compliant funds? Well, firstly, they should not generate interest. It's because interest is seen as potentially unjust and exploitative, which means that the interest is generated off debt, and that debt could be having a negative impact on somebody else's life, and therefore it's prohibited. Secondly, the investment should be in asset-backed investments or businesses that are having a positive contribution to the real economy. So that's essentially where the growth should be coming from, where the businesses or the assets are contributing to the economy. That being said, there are some businesses that are excluded, and these are businesses that can potentially have a negative impact again on the individual. And these are such businesses like alcohol or companies that whose core product or profits come from the sale of alcohol, the sale of tobacco, the sale of adult entertainment, or gambling. So all of these potentially have a negative impact on the individual and therefore are prohibited in Sharia compliant funds. Ideally, there should be a profit and loss sharing structure. So investors share in the profits and the losses, and this promotes the risk sharing and it discourages speculation. So that's ideally where a Sharia fund should be investing into. It's about profit and loss. It's not about earning interest. It's not about debt. And it isn't about investing in companies that have a negative impact or potentially can have a negative impact on people. It's also important that Sharia funds maintain full transparency for their investors so that their investors can ensure that all the investments being made within the fund are in fact Sharia compliant. For this reason, Sharia funds do make use of or employ the use of a board of between 3 to 5 Islamic experts or scholars who will screen each investment in much the same way as managers would with an ESG fund. The funds must be audited annually to ensure that they're fully compliant with Sharia principles, and all the non-permissible income should not be more than 5% within the fund. Sharia compliant funds are made up of equities or sukuks or a combination of equities and sukuks. This would refer to the majority of Sharia compliant funds that are available. Equities would be companies that are publicly listed. Of course, this excludes the haram companies such as companies that sell tobacco or alcohol or defense and weapons and so on. But essentially, you're holding shares in companies on the stock exchange. Sukuks are similar to a conventional bond in that they have a maturity date, they have an income rate, and there's a credit rating that's involved as well. But they are different in that a conventional bond earns interest off the debt, and a sukuk is a share in an underlying asset, and the profits that the asset generates will then go to the sukuk holder. If I can use an example, let's say we have a company, an airline, and they've purchased an aeroplane. They can place the aeroplane into a trust and sell the aeroplane to investors via sukuks. So all the investors essentially become shareholders of that aeroplane, of that asset. Now, all the profits that are generated because of the asset are distributed to the sukuk holders. There will be a maturity date of this sukuk, and at maturity date, the company would repurchase the asset from the sukuk holders. If there's any significant depreciation or any issues with the asset, the sukuk holders do face that risk, and it could impact their returns or their profit sharing. So a sukuk does represent a risk sharing between the sukuk issuer and the sukuk holder, and because of that, it makes it a Shariah-compliant vehicle. I would like to share 3 insights that I hope will help you enhance the performance of your Shariah-compliant investment portfolio. The first one is diversify into offshore assets. The problem with having a Shariah-compliant portfolio that is concentrated in South Africa is that on the JSE, there's only approximately 270 companies that one could invest into. Out of those 270 companies, a handful of them are not Shariah-compliant, which reduces the options even further. So for a Shariah-compliant fund that's only invested into South African equities, the options are limited. And therefore, the potential for generating returns and outperforming the market are limited as well. So it's important to diversify outside of South Africa, where there's just tremendous options available to the investment manager to generate good growth for the investor. Secondly, I would suggest to ensure that your investment portfolio is appropriately diversified. Sure, if you're taking a growth approach, you'll be invested primarily into equities, whether it be within South Africa or offshore. But in addition to that, one should also ensure that your investment portfolio is not focused on a particular geographic location or a particular sector. As an example, say if you invested into 2 Shariah-compliant equity funds and they both take a growth approach and are heavily invested into the tech sector, and suddenly there's a dip in the tech sector for whatever reason, your entire portfolio is then impacted. Whereas if you diversify across a value-based investment approach and a growth-based investment approach, they would then be invested into different sectors, and that would reduce the volatility of your investment over time as well. And thirdly, to further diversify the investment portfolio and potentially improve investment returns, a Shariah-compliant investor can also consider investing into Islamic REITs, which are real estate investment trusts. This is essentially a Shariah-compliant way to get exposure to the property sector. And then commodities is another asset class that one could also consider. They are Shariah-compliant as well. Commodities such as gold is an excellent inflation hedge and an excellent rand hedge as well. So if it's suitable, consider including those asset classes within your investment portfolio. That's it from me today. I hope you found that helpful. If you have any questions, you're welcome to contact us. Have a great day. Bye.